This next one is a personal favorite of mine, Calling Balls and Strikes. It is all about crypto information and data. How do investors, how do industry insiders make heads or tails of the fast moving industry and all of the data that's coming out of it? We've got three of Messari's partners, Dave Balter from Flipside Crypto, Amber from Kaiko, Nick Carter from founder of Coinmetrics and Castle Island Ventures, and then our own Chao Wang is going to facilitate the discussion. So we're going to leave it to those guys. Should be a fun conversation. We're going to get into the weeds here.
Hello, hello. Welcome. Long time no see, Nick, Amber, and Dave. Today we're going to talk about data, crypto data, the state of data quality. What are some of the data sets that people can use to make better decisions? So without further ado, let's start with a quick round of introduction. Two things. Number one, who you are and what your business is. And number two, your favorite data product. You're not allowed to say your own thing. So Nick, you're not allowed to say Coinmetrics, for instance. Let's go. Nick, go.
Hi, thank you for the invitation. Happy to be here. Great panel. I thought the last panel was great too. I'm Nick Carter. I'm a co-founder of Coinmetrics, which is a on-chain and market data business in crypto, and a partner at Castle Island, which is a crypto venture firm. In terms of my favorite data product, which is not one that I am a part of, I use Messari a lot. So good job, guys. And I like Old Faithful. I like blockchain.info. I've been a user of their charts for a long time. They actually partially inspired me to start Coinmetrics. So big fan of those guys.
Awesome. Amber?
Hi, thanks for having us. So my name is Amber Soubiran. I'm the CEO of Kaiko. We're a crypto market data provider based out of Paris with an office in New York and in Tokyo. And in terms of data, that's a tough one as well, not to state your own when you're running a data business. But I'd say that also going back to kind of traditional data businesses, I'm a big fan of how IHS Markets as a company has developed over the years. I think they were in a very interesting space from the kind of early on, and managing on kind of get relationships with non-public data, and all of the way they've built the company is very impressive. And coming from a traditional background, I've spent a decade in traditional capital markets before crypto. And I think IHS is a really impressive company. So yeah.
Dave?
Hey everyone, Dave Balter here, CEO of Flipside Crypto. We provide business intelligence to blockchain organizations. We also produce something called FCAS, Fundamental Crypto Asset Score, which is a fundamental health for crypto organizations. As it relates to other data providers, I mean, at odds with taking care of your co-panelists, I'm going to have to say Coinmetrics. I mean, they were early in our journey, and we actually use them for a variety of things. And I do anything I can to make Nick smile. So if that got him, we're all winning.
Nice. Let's start with a fun one. What is your favorite indicator, fundamental indicator to value crypto assets?
Should I start?
Yeah, sure.
Like Aswath Damodaran says something about cryptocurrencies. He says, they're currencies, they can't be valued, they can only be priced. I would disagree with that a little bit. I mean, we're talking about emerging, monetary synthetic commodities, and there's drivers of supply and demand, which can both be modeled and understood. I would say, actually, you guys might be expecting me to say realized cap here, but I would actually say something like the dispersion of addresses. So the number of addresses with certain thresholds of value in them, because that's like a pretty strong kind kind of indication of the growth of the holders of that asset. And unlike,
so when you say dispersion, you mean like some kind of Gini ratio, like some kind of how distributed the ownership is?
Yeah, you could compress it into a Gini ratio if you wanted, but that's like a pretty lossy compression, right? So I guess I'm not even referring to a single metric. I would say like just the array of metrics, which allows you to understand how dispersed the ownership of the UTXO set or the account holder base is. And to me, that's very positive. And also the first derivative of that number, right? Which shows whether it's in a dispersive phase or a concentrative phase. And my view of this is like if you have concentration in the holders, you have an increasing phase of concentration, then you're in a period of morbidity. You know, things are not looking good for your coin. So I think you always want to see that expansion of the holder base.
Yep.
And just to bounce off what Nick, just to bounce off what Nick just said, I think from an on-chain data perspective, it's also interesting to look at usage and velocity and like how not just concentration, but also how many active wallets you have, how many people are actually moving money around versus kind of holding and being very static. I think that's a very interesting on-chain metric as well. And going back to my bread and butter, I'm completely obsessed with order book metrics and how you can derive order book data to have kind of more liquidity related insights on the markets. And so everything about, you know, slippage, market depth, how market depth quickly depletes when you have large market moves. There's so many things you can learn from order book data that goes way beyond just pure price information. It really, you know, gives a lot around market microstructure and how stable the market actually is when you look at the depth of the market. So yeah, that's something I find very interesting. We're actually, we'll talk about it later this afternoon, but we're actually releasing a full kind of suite of order book data products on Mainnet this afternoon.
Awesome.
Well, I'll build on this a bit. I think we've heard two highly sophisticated point of views on some of the traditional metrics that people might follow. You know, and I agree, you know, whether it's supply or inflation or interest rates or price, order book depth, et cetera, all very important. But I tend to try to think of this space in sort of a continuum. We've you know, begun at sort of almost backwards. Let's look at these assets as you might a traditional equity and invest against that, as opposed to each of these assets happen to be backed by a business or an organization that is attempting to run like a business. And so if you might look a few years out, an investable asset might be one that has real customer metrics, things that you might understand maybe as you're investing even in equities today: user growth, retention, CAC, LTV. And so my sense is what we're missing in this space is more prominent indicators of ecosystem performance that would indicate that these assets are actually growing as real organizations. So I'd like to see more of that out there.
And actually, that's what Vasari is trying to build, right? Is more information on the actual businesses and not just kind of data metrics, but actually all the self-reporting part and all the you know, disclosing the kind of protocols businesses are actually I think agree to your point, Key.
Yep. I want to touch on each one of the points that you guys mentioned, and I want to ask if you have a interesting case study related to the data set that you mentioned. So let's go the other way around. Let's start with Dave this time.
We go in reverse. Well, I'll just say to give some background. What we do as a business is we chain walk blockchains. That means we use behavioral modeling to extract different types of stakeholder behaviors from chains. We have about 40 chains that we work with. And so we might be able to distinguish the difference between a speculator or a miner or an actual customer. In the stablecoin realm, we'll distinguish between what's coming out of escrow versus what's being minted, et cetera. So maybe if we use the stablecoin theory a bit, you can once you start looking at stakeholder behaviors within stablecoins, you'll see that DAI is really the only one that is being used deeply for decentralized finance, while Tether is mainly being used for ARB. And so that begins to give you an indication of where are their customer metrics, right? Where are their actual usage? Not to say that Tether is an investable asset, just it's being used primarily by traders for trading and moving back and forth. So I would like to see much more of these types of real indicators. Well, what type of usage, not just our tokens being moved around, but what type of usage is occurring for these types of assets.
Amber, you want to go next?
Yeah, absolutely. I think your point is super interesting, Dave, and like I think the usage basically for Tether is really about de-risking and kind of hedging and moving back to a stable currency without having to go through the kind of more traditional financial system. And that it's clear. And the DeFi, I think it's going a bit to what I'm going to say about Bitcoin, and to expand on the order book thing earlier. DeFi applications with DAI are absolutely awesome, but still very niche, I think, today in terms of volumes. But going to kind of a case study using order book data, we published something around the Black Thursday crypto crash mid-March, where you could see that the depth of kind of volumes that was placed across different markets got completely depleted in like less than an hour. And I think it's interesting because, especially with the current kind of economic context of like money printing and all the central banks, trying to come up with a solution for the current situation, we've heard more and more large, super smart investors talk about blockchain and crypto as a kind of macro hedge or hedge against inflation. And we hear all these words, which is awesome for our space and our ecosystem and the kind of attractivity of the space. But all of that is still completely conceptual. Like we're still in a world that is highly illiquid in that sense, in the sense of a macro hedge. And we've seen that, in a context where the economy goes a bit haywire and things go off, the market depth just depletes it right away, spreads explodes, your volatility increases, and there's just, it's not yet an asset that can be considered a hedge against anything, in my opinion. However, it's wonderful for us because it brings a lot of attention and a lot of interest to the space, because conceptually it is a real, hedge against inflation. It's just we're not there yet in terms of size and volume. And this is extremely flagrant when you look at it from just looking at the order book metrics. Over the month of March, you could see the kind of market impact that was obviously visible in the trade price, but you could see how it very, very strongly impacted the order book structures.
Amber, I'm curious if you have any insight into, for instance, how big of a trade is able to move the market by X percentage? Do you have any data really?
So yeah, I mean, we have the data, and actually we'll be presenting some of that later today over the session at I think 4 p.m. New York time. So invite you to join for like detailed information. But we basically see the market impact, which we define as the price slippage for different order sizes, and price slippage is somewhere around 10 bips on Bitcoin for like 50 to 100K orders, and then above that it starts moving the market quite significantly. So orders, market orders above 150 to 200K starts being quite expensive in terms of how much of the order book you're actually eating up. So if we just look at that from a price stability standpoint, an order of 100K to 200K can start messing up the price quite significantly, which we're talking on the largest exchanges.
100K dollars.
Dollars. Sorry, yeah, absolutely, not Bitcoin. Okay. Yeah.
Got it. Cool. Nick.
I'll give a case study. So one way to think about the metric that I was talking about is to define a threshold of balances and then just count up the number of addresses that have a balance of that size. So for instance, 0.1 BTC. And if you look on the chart of Bitcoin, it looks a little bit like the price chart actually. has these really rapid expansion phases, slight concentration, but just generally the trend is growth as the user base gets more dispersed. And then it's an interesting way to evaluate the relative merit of forks, because forks inherit the old UTXO set. And so if you look at the BSV, BCH, and BTG forks of Bitcoin, after those forks occurred, this number actually contracted. It flatlined and contracted in the forks, while Bitcoin kept growing. And so you might juxtapose that against, like transaction value or transaction count for some of those fork coins. You see that they have an apparent vibrancy because there's lots of transactions going on. But if you look into it a little bit deeper, you see that the transactions are kind of like for the insertion of arbitrary data or for tipping services, or actually it just could be straight up spam transactions. And it's not a function of actual commerce really happening. The entities transacting are mostly the same entities. And there's not, evangelism going on. There's no additional new dispersion. There's no new user acquisition. And so if you contrast the number of addresses with, for instance, 0.1 units of the currency for the parent asset, so Bitcoin, versus the child assets, you see this, they have kind of different trajectories after the fork, even though up till the moment of the fork, they obviously have the same history, the same UTXO set. So it was when I noticed this, I figured, okay, these forks are exhibiting kind of like symptoms of morbidity. They're not like particularly healthy. Now, maybe they'll have a turnaround and they'll surprise me. But that was one thing that I thought was pretty notable in terms of actually comparing these assets.
So, so on that note, what do you think of the role that exchanges play in this data set? Because I'm just hypothesizing. You could argue that over the years, exchanges have changed the way that they store coins. That may have an impact on how you see this data set evolve over time. And exchanges are obviously a very big part of coin ownership.
Yes, absolutely. And so they actually bias the metric in opposite ways. So obviously, many users can account for one address on chain at an exchange if they're using an omnibus model. And also, some exchanges have extremely dispersed on-chain impacts. So exchanges themselves will account for hundreds of thousands of UTXOs. Some exchanges just are extremely wasteful in their on-chain footprint. I don't know why exactly. Maybe it might be related to privacy. So it affects the metric in both ways. And as you say, it injects bias into the metric on a time series basis if there's a discontinuity, if they change the way they engage with the chain over time. And so you can see that, for instance, in Bitcoin, you can see there's this significant contraction in addresses in early 2018, in January, February, March 2018, as the fees went down on Bitcoin, and these entities with really significant UTXO sets were able to consolidate those UTXOs. But previously they couldn't. They actually had a lot of stranded outputs because the fee to spend those UTXO is more than the value of the UTXO itself. So certainly the role of exchanges is very significant. There's a big on-chain imprint there.
Mm-hmm. Dave, I know. So Amber, I know you spend most of your time building market data, but Dave, you have quite a bit of focus on on-chain data as well. What do you think of this what Nick just said?
Well, I'll just add a little bit of a layer to Nick. I can't speak to the economics of some of this, but so one of our tools allows us to automatically detect exchanges and all of their satellites based on behavioral patterns. So the exchanges, as most know, are a mix of sort of hot wallets and cold wallets, and the exchanges are changing those wallets all the time and changing the satellites. Partly, I'm going to guess, for security, and partly just so no one knows where their money is, et cetera. But one thing you tend to notice is that the exchanges are doing a lot of inter-exchange movement of assets. So assets, while we're seeing, you might be seeing trading on a what looks like trading on a platform, what you're actually seeing is them moving their assets around their internal exchange or their internal wallets. And so we see that as maybe the word fake volume at times, causing some changes to the price or other areas where people are reflecting actually what's happening. But the truth is, when you get underneath all of it, you're actually going to be able to parse out many of the behaviors are just the exchange operating its own system. Now, I don't know how it feeds all the way out to the ecosystem price, but I can tell you when you're looking at a specific asset and wondering about how they're performing on an actual user behavior basis, their customers, are their customers using this? Are speculators behaving in a way that is healthy? Oftentimes that can be obfuscated by the exchange performing its own inter or intra exchange movement of assets.
I've actually read a metric somewhere that 90% of on-chain transactions can be identified in a way that at least one of the sender or receiver is an exchange. Does that sound right? Or
I would say I can't speak to the percent. I can tell you it doesn't seem from what we know from the clients we work with, that is not out of norm. It is different per asset and per times in the life cycle of that asset. When an asset may be launching on an exchange, when an asset may be going through a major transaction, you'll see those percents change. But yeah, a lot of the volume is just the exchange or the bank, so to speak, moving assets within itself or to each other.
Are we talking mostly about people kind of withdrawing from exchanges and people funding accounts on exchanges, or are we talking about like internal settlements and exchange, internal cuisine?
Yeah, I think
yeah.
That's a good
So what I'm talking about.
Yeah, go ahead.
Go ahead. Joe, go ahead.
No.
I was saying internal settlement, but the problem is much of that settlement is often aligned or assigned to what we might consider actual speculator behavior. It is not distinguished when it flows all the way through to the metrics that many people view in the market. That distinction, like we look at the clarity of settlement, that is a transactional term, but that clarity, it doesn't often go all the way through from the exchange to the metrics that people see about volume and where stuff is outside of the exchange and their actual customers.
Yeah, just to chime in there, 90% doesn't sound too far-fetched to me. Again, agreeing with Dave, it really depends on the asset. Some assets are entirely captive to exchanges. So like certain coins like LEO, they nominally exist on chain, but effectively they just exist within one exchange. Whereas for Bitcoin, I don't have these estimates in front of me, but it's certainly high, probably higher than people expect. But there's also standard commerce that occurs there, not through the vector of exchanges.
It sounds. Do you have from the top of your head? I mean, I guess 90% is probably Bitcoin is more of a kind of store of value investment asset, whereas Ethereum, for example, is probably the most used blockchain in terms of real applications. Do you have any order of magnitude of what that kind of number is for Ethereum?
It really depends on how you want to quantify it. In 2017, for instance, just Coinbase's behavior on Ethereum alone accounted for about 90% of the transaction volume in dollar terms. Just their wallet management practices. It's different today, of course, but one thing that I like to look at, which is maybe more interesting, is the share of supply which is held on exchanges. And I think for Bitcoin, it's around 20% of ever mined supply is held with custodial entities, which is a broader category than just exchanges. And for Ethereum, it's in the same range, 20 to 25%. So it's interesting to note how these things end up back in banks, at least a certain fraction of the supply.
Switching gears a little bit, what do you think are some of the biggest holes in crypto data today? Meaning, what is something that you would like that doesn't exist today that you would like to build?
Well, I'll start since everyone's probably thinking, but I'm building the thing today I would like to build. That seems like a perfect meatball to say you should go check out Flipside's data cooperative. The thing that we wanted to help people understand was this distinction between stakeholder types and token movements. So for example, if you go to our data co-op and you look at XRP, you can see that they're minting, you know, 1 billion every month. 1 billion XRP comes out of their mint, and just 10% ends up hitting exchanges. You can see daily activity dominated by top movers, people who generally trade XRP, and exchanges, and that their patterns or behaviors are happening during the week, not on weekends, which would indicate an institutional base, not a retail base, right? And so, you know, I would say the thing we've built, the data cooperative, is a useful tool. You're going to see a lot more data that we'd like to build. Let's lean towards your question. In that helps people start to break apart and distinguish ultimately what these assets are really doing. So getting to that ultimate sort of CAC, LTV, what is a user typical life cycle within one of these asset bases, which in the end is going to influence, you know, price and all the other things that we are trying to pay attention to today.
So I'm going to do a bit of advertisement for Messari, but I think two things that are really lacking right now in the industry. One of them is this. No, I mean, I remember one of the first times I met Ryan, he was telling me we want to build the Edgar of cryptocurrencies. You know, we want to have kind of more transparency, be a centralized place where people can, you know, publish white papers, yellow papers, have this kind of information. And that goes back to what we were saying earlier about kind of in, you know, traditional equities, you have some of those kind of fundamental data that underlies the way you approach a company. And it's very hard to do that in crypto because of all the opacity sometimes around the projects. So I think that's something. And that brings me to something else, which Messari has been working on actively, and we've actually partnered on that on a couple of things, is transparent supply. Like, supply is a horrible, like, for me, it's something that is really missing in the industry. And ideally, I would even want to have, you know, supply that as part of like the metadata information in blocks. Like, miners would have to whatever update a supply metric that would be, you know, provided somehow in blocks. I just think this is something that would bring so much transparency in the space, that would be so important from I'm an investor, or I'm a user, whatever I am, I'm basically going to end up holding some of that asset. I need to know how much of that asset there is in the world. And especially in the context when we talk about inflation, when we talk about so many, you know, things about transparency that are important, having clarity on how many of those are there out there in the world is such an important data point that we currently don't have any visibility on, or we do, but it's not perfect. I mean, for Bitcoin, it's algorithmic, it's okay, we can calculate it. For many other projects, it's still kind of very, very obscure.
Yeah, so yeah. Amber actually...
Not only...
Yeah, go ahead.
Go ahead.
I was just going to say, Amber said what I was going to say, so... but I'll reinforce that. Yeah, I mean, a good transparent measure of supply, weirdly, is something that is still kind of being worked on. I would say that's still kind of a work in progress. Obviously, there's a lot of assets out there. And, you know, it's interesting. There's some cases where miners or stakers do commit to a supply figure. So Stellar was one example. And in that case, it's one of my favorite case studies because there was effectively covert inflation. There's an inflation bug in Stellar. And the measure of supply that block producers were committing to actually wasn't the real supply, because it wasn't really being fed off information on the ledger. They were committing to like a kind of a fictional figure. So I'll add to this and say, for the most reliable measures of supply, it requires auditing the ledger itself, every entry on the ledger. And in Bitcoin, it's kind of trivial. It's not that difficult. In certain assets, it's actually prohibitively difficult. I'm not going to name names here, but you do need the ability to run kind of a full archival node, to parse apart the some clients, which actually might be closed source. And if it's poorly documented, you may not actually have the ability to fully audit supply with regular resources available to a data company. So some of these assets are really challenging to audit by definition, by their very nature. I think it's something that collectively as an industry we should do, because the numbers on CoinMarketCap, not to punch down or call out anybody in particular, aren't really grounded in truth. To be just perfectly frank, they're approximations, they're kind of best guesses. But yeah, I think that's one of the most important things we can work on, is just getting more certainty around supply.
Yeah,
and it's funny.
Go ahead, Amber.
I was just minor comment, but being a market data company, people think that market cap is a market data point. And very often we get customers, we work a lot with people that are building ETFs, indices, people that need market cap or network value, or however you want to call it, in order to do some rebalancing mechanism or to put it as part of their methodology for building a financial product. And market cap is literally the price of the token multiplied by supply. And this is a big problem that has a lot of waterfall consequences when you get it wrong. And so, it's just something that for me is key from a kind of industry growth and institutionalization, very hard word to say, perspective, is really just kind of getting an idea of what is actually the size of the cake, pretty much.
So this is actually a really good point. I want to ask a related question. So y'all mentioned that supply is something that is the supply data that's being circulated around on the various data platforms are just incorrect. Not only do they use different methodologies, but also the data itself might just be completely wrong. So a related question would be, what are some of the other data sets or data points that you see people talk about or use, on Twitter, people discuss that they use to, for their decision making, that you think is very misleading, that you want to basically caution people against?
Well, there's endless ones. I think the history of looking at crypto data is a history of misleading data, or people reading into data points in a way which doesn't really suit the data. The canonical one is definitely transaction count, I would say. Even just in the Bitcoin context, people don't understand that a transaction can be a bundle of thousands of payments. And so, maybe that's the more interesting or important thing to look at. And then you have chains where it's very cheap to manufacture a lot of transactions, which ignores the trade-off there, which is it's very expensive to run a node in that instance, potentially prohibitively difficult to run a node. So it's not exactly a like with like comparison. That's probably the most interpreted one, I think, in my experience.
And to that, I think it's really interesting because, and correct me if I'm wrong, I'm not a specialist on the on-chain data stuff and how exchange settle their own intra-exchange transaction. But I feel that if you look at transaction count from a market data perspective, you'll have all the transaction, all the trades that are executed on exchanges, as in people buying and selling and kind of, the matching engines doing their job. But you don't see real usage of the actual blockchain, which is kind of transactions from one wallet to another. So I don't know exactly how often exchanges nets transactions, but if you look at our market data, you'll get count. We have a metric called count, which is just count of number of individual transactions. And it's an interesting metric. And of course, when there's more count, we can kind of assume that there's more velocity and more activity, but it doesn't reflect everything that happens on chain, which is people actually using the blockchain and not just buying and selling the assets. So I think that part is really interesting. And going back to the market data side is, I think it's very misleading to look just at price across exchanges without looking at the order book structure. Sorry for getting back to order books, but I think, you can compare some very tiny low volume exchange somewhere in the world that trades against Tether, and the price may be better there technically, but you could actually have zero liquidity, zero depth. You could be impossible to actually transact anything valuable there. But so the combination of on-chain data and market data, I think, is probably the kind of the right approach, even though on-chain data requires a level of abstraction higher in order to really understand how to integrate that. I feel like price is very straightforward. People have been using prices for other assets since forever. Network data is new pretty much to the blockchain space.
I don't want to go too deep beyond what Nick and Andre said. They were both very good. I'll just say we do see a lot of teams attempting to game their data. So not only are there hard things to follow and things that are opaque, but as an example, in a totally different sphere of this, developer behavior, which is an indication of whether or not an asset is being worked on or the fundamental technology is being worked on. We will see teams do things like instigate dumping a lot of code at certain times, or moving stuff in or out, et cetera, to create the perception that there's a lot of development or effective transformation of their technology. And we're seeing that across a non-financial metric, but we do see some of that type of gaming behavior working, or teams working on that directly. So I would just say we would like more transparency, but we would like better sort of cause and effect metrics, meaning the ability for teams to have indicators where there are, or investors to have indicators where there is abnormal behavior patterns that are starting to exist, and to make those public, because I think those that are maybe doing things that are intended to deceive, they should be called out for it.
Yeah, again, that ties back to everything that Amber and Nick mentioned, in terms of identifying the addresses on chain. That will give us more. Well, we're right on time.
Ryan, is that a song? What is it? What is that? What do you got there?
Whoa! All right, slamming it. Called out from the guy who was here.
It was beautiful. It was beautiful. It was beautiful.
Goodness, I was just here to help you wrap up. But if you're all,
I was gonna wrap up, and
yeah, go ahead. Go ahead.
No, I was just gonna say, ties back to everything about identifying, the key actors on chain, and help us better understand how the transactions are made by the insiders, how the supply is divided between the insiders and everyone else, that kind of stuff. Basically everything that Masara has been working on, but also everyone else here.
Thank you everybody for joining. We're going.
Thanks a lot.
Our final
Thank
segment.
you.
Fantastic though.